was going to bring in Kevin Hassett, but I do want to make a point. I had Jenna Stauffer, who is in real estate. She was with me in the last hour, and she said that even with interest rates, say that the 30-year hits 8%, Kevin Hassett will take this to you. Even if the 30-year, which is the most popular mortgage in this country, hits 8%, she doesn't think that there's going to be a substantial fall in prices.
Right, and it's something that we're seeing, although, you know, the housing market has significantly cooled for sure, but prices are staying up, I think, in part because there's not a lot of supply. The bottom line, though, is that, like, thinking back to all the people entering the labor force, there's like a warning I have for everybody about reading these data, which is that when people come into the labor force, you get a mix shift in the wage data because there are lower wage people coming into the labor force. And so you have to look at things like the increase in wages for people who are, you know, had a job yesterday, had a job today, and there's some places at the Atlanta Fed where they calculate that. But the wage data, I think, is actually, the wage inflation is running now at about the same rate as price inflation, maybe even a little bit better, but it doesn't look like it in the statistics because of the mix shift.
All right.
And so I think that one reason why people are continuing to buy houses is that the people who have had a job throughout are actually seeing wage increases.
Well, you know, Becky, again, going back to the earnings numbers that we got here, the average earnings, you know, month over month, it was a little bit lower than expectations, just by a tick on both year over year and month over month.
Yeah, and if you pull that apart, Cheryl, so there's something called the delta between the advantage to people, the wage increase you get for leaving your job for another one, and the wage increase you get for staying in job. And the delta between those two, favoring those who are leaving jobs, is now about 3%. So you're getting about 9.5% increase for leaving your company for a new job, and about 5.5% for staying at your company. That delta has shrunk considerably, exactly to Kevin's point, in terms of wages today, wages tomorrow. You're getting less money for staying, and you're getting less money for leaving. But we still are advantaging. American employers are paying more for new talent to come in the door. And one of the reasons they're doing that, Cheryl, is because the time to hire, we haven't talked about that, the time to hire for employers is now a month and a half. It takes 44 days to get a new person onboarded and hired versus 27 days before the pandemic. And if you get into in-demand roles like engineering and medical, which you see high demand for, it's 88 days. So we're up to 3 months. And so employers are still suffering from a bit of this pandemic paranoia and holding on and hiring for permanent roles.
Brian Payne, you were talking about that earlier.
Yeah, that resonates with me as a business owner, Becky, and I have mostly women that work at my firm, so I like to see the uptick in women in the economy. But I think what's happened here is, as an employer, we all had the shock of having to raise wages because inflation went up so much that every employee was demanding that you pay more, and the competitiveness was tremendous. What I think you're seeing now is just the cooling off of the moderating of that, and I'm seeing it even with my own business. I don't have to give the same wage increases that I did a year ago, and I think that's great for inflation. That's great for employers. That's great for profit margins, and that's kind of that, again, that Goldilocks scenario where, you know, productivity is starting to increase, which is also disinflationary, by the way. And, you know, people are seeing their wages go up over inflation, but more moderately. Like, that's the sign of a very, very healthy economy. This is where we've been trying to get to for 2 years, and we're finally getting there.
Lewis, one of the things about the employment rate going up from 3.5 to 3.8% is that this means that more people are looking for jobs. More people are looking for jobs than found them. How do you interpret that? Is that a good reason, a bad reason, in your opinion?
Well, obviously the kids graduated. That's one thing. Another is people probably got to pay their credit card debt because it's skyrocketing. So yeah, households are tight, and you see it in no one wants to buy any goods, whether it's electronics, appliances, vehicles. You know, all the big ticket items aren't selling, so people are hurting. So they have to go out and find some more work. And as Charles mentioned, I think we added over 700,000 workers to the economy last month.
Yeah. Well, and Steve, I mean, that's the thing, is that people are going out and having to get 1 job, 2 jobs, 3 jobs, which doesn't really make me feel very confident in where we're at in the economy. But remember, Steve, Bidenomics is working, they say. You know, and I do want to point out to everybody that we are going to hear from President Biden. He's going to be talking about the jobs report at 11:15 a.m., Steve. So I'm sure that he's going to find many reasons to celebrate.
Yeah, look, I think this is a decent jobs report. But I just keep wondering whether we've maybe hit the tip of this job spurt that we've had over the last few years in the kind of post-COVID era. again, I go back to this. I'm so nervous about this debt situation and the household debt. We've never seen anything quite like this before, where people, and again, this is the point that Charles made, that sometimes we miss with these economic statistics, that people, if you talk to people on the street, people come up to me after I do the show and they keep saying, why do you keep saying inflation's only 3.5% or 4%? I'm paying 7, 8, 10, 12% on everything I have to buy. And I think there's just some misleading, there's something that's sort of deceptive about these numbers when people are telling us that, boy, I'm having a harder time paying my bills every month.
Well, Kevin, again, we're going to be hearing from President Biden. He's running his reelection campaign on Bidenomics. You were in the White House. Is the economy strong right now? I mean, because I remember under the previous administration, we did not have unemployment that looked like this.
Right. Well, the fact is, there were times, but the fact is that real wages have declined. Wages are starting to try to catch up, but, people are worse off now than they were when President Biden took office by quite a bit, because inflation reduced their spending power so much. And so, I think that the economy in the third quarter, a 5% GDP growth is a significant number. But I think Steve's right, that if you look at how much debt people have and what their debt service payments are, because interest rates are high, like people are paying 20% interest on some of those credit cards, that people aren't going to be able to consume this year, next year like they are this year. And so I would expect that, that Ray Fair at Yale says that it's kind of second quarter GDP next year that has an influence on the election. And I would expect that by second quarter next year, people are going to be pretty sour on Bidenomics.
Okay, Becky, final thoughts?
Yeah, I want to bring us back to who's hiring in the country today. So the number one company in the country who's hiring is Walgreens. So opportunities for flexible work, part-time work, et cetera. Number two is Compass Group. Most open jobs in the number two position in the country. Who is Compass Group? They're a food service company, which brings me back to hospitality and leisure. I do agree that Americans are managing their pocketbooks, but they're eating out. They're just doing it more affordably.
That's interesting. Kevin?
Mm-hmm. Yeah, I mean, so I think that you're seeing that in the data. And the bottom line, though, is that people are upset, as Steve said, because even though their wages are going up, they haven't, closed the gap. They're still down, 15% or something because of all the inflation that happened in previous years. And so my view is that the strong economy that we're seeing right now is kind of like the last gasp, but the Fed is nervous about it. That's why they're talking about risks at Jackson Hole. And so I still think, I'll bet you guys, I bet you that there's a rate hike this year because the inflation now is 0.8 and GDP growth is 5. You could have GDP growth higher than the federal funds rate, and you think inflation's going down? I mean,
Ryan Payne's ready to take that bet real quick, right?
I would love to take that bet. Next year is an election year, and I think Steve Moore has it right. Conditions are tighter than the numbers are showing, and I think that's just reason for the Fed to cut next year during an election year.